over 15 months as a result the aftershocks of the recent confidence crisis in the banking industry that outright overshadow energy traders' optimism from China's reopening prospects. As contagion worries subsided, however, optimists slowly re-entered the picture and lifted WTI near the $70 per barrel, where it is currently traded at. In this report, we aim to shed light on the catalyst driving WTI's price and assess its future outlook. Last week, the International Energy Agency upwardly revised its global oil demand estimates for 2023, citing that a strong rebound in worldwide traveling alongside China's return to normalization would push consumption to record highs. In this monthly report, the organization foresees that the global economy would require additional 2 million barrels per day extra this year when contrasted with energy demand levels of 2022, and boldly stated global oil demand growth started 2023 with a whimper but is projected to end the year with a bang. IEA also places significant attention to China's solid economic momentum that drives energy demand levels higher, since the largest oil consumer in the world has now pushed the pedal to metal and pursues its full-fledged reopening agenda after the abrupt abandonment of its strict zero-COVID policy. It's also added that Chinese air traffic with domestic flights is now well above pre-pandemic levels, which is seen as another solid reason for an even stronger rebound in demand. Following the dramatic events for a possible collapse of Credit Suisse last week, market nerves calm as SNB forced UBS to take over its distressed competitor in an attempt to restore market confidence and ensure financial stability. Even though it is too soon to tell whether the recent turmoil is ultimately over, the market apprehended the news positively. Therefore, since the prospects for a systemic overspill scenario started to dissipate, energy bulls entered the picture and helped put a floor under WTI prices. Adding more confidence to the case of bulls were the comments by US Treasury Secretary Janet Yellen, who stated that the government is willing to take further action to protect deposits. However, yesterday she stated the government is not considering a blanket insurance policy. Further comments and developments, therefore, will be monitored closely as we move forward, since a recognition of contagion worries could once again put extensive pressure on WTI prices. On Tuesday, the weekly API crude oil inventories figure pointed to buildup of 3.2 million barrels in stocks, higher than the expectation for a drawdown of minus 1.4 million, while yesterday EIA's weekly oil inventories recorded a rise of 1.1 million barrels of crude, exceeding expectation of minus 1.6 million drawdown for the same period. The results suggest weakening demand for crude. However, WTI's strength since the start of the week indicates that the aforementioned buildups had no material impact on pricing. It is important to strike out that the API crude oil inventories have been recording consecutive pile-ups since the start of the year, with only 2 weeks since the recording a drawdown. Similarly, EIA crude inventories have been recording excessive buildups for the same period, with only 1 week reporting otherwise. Overall, the apparent continuation of large pile-ups in crude stocks from a 3-month historical point of view reflects deteriorating demand for oil, which could be explained by expectation for a slowdown in economic activity from energy traders and the market as a whole. Lastly, we would note that last Friday, the Baker Hughes oil rig count showed that the number of active oil rigs in the US has dropped by a count of 1, reaching a total of 589, which could serve as another indication for a slowdown in demand. Thank you for watching.